going to talk about technological progress. And I touched on this a little bit last time in the context of the neoclassical growth model. Now, the most common measure of technological progress, even though it's not really a pure measure of technical progress, is to think about productivity. And productivity, the most common measure of productivity is called labor productivity. So when you hear like the productivity statistics that are typically cited, you know, productivity grew at X percent, it's normally labor productivity they're talking about, which is just Y over L. Okay? That's just the ratio of output to labor as output per man hour is the kind of notion. It's usually done in real terms. Real output per man hour. So that's one measure of productivity, right? It's a measure. It's equal to the average product of labor, right? It's how much, on average, does labor produce. Output of labor, output divided by labor is the average product of labor. There's another measure of labor productivity, of course, which is W over P, because that would be equal to the marginal product of labor, right? That is, in a competitive market, the wage equals price times the marginal product of labor. So that's the competitive market profit maximizing condition for a firm. Therefore, W over P is the marginal product of labor. So that would be an alternative way to think about measuring productivity, right? This is just a marginal product of labor. So we have two ways in which we can think about measuring growth in labor productivity over time. We can either measure increase in output per man hour, or we can measure increases in the real wage. Now, of course, the ratio of these two numbers, W over P divided by Y over L, is just equal to WL over PY equals the share of labor. So if you're in a world in which the share of labor is staying roughly constant, then actually these two measures of productivity are going to be growing at roughly the same rate, right? So for a long time, the share of labor, it varied somewhat, but it was relatively constant, certainly to the growth, relative to the growth in either of these. So as output per man hour was growing, real wages were growing, and the share of labor was staying roughly fixed. Okay? So both these measures of productivity growth kind of gave us the same message. And if you looked over a long time, you know, we got significantly richer as measured by labor productivity. Both output per man hour and the real wage rate were increasing substantially. That's part of that long-run growth process that people tried to model with the neoclassical growth model. Okay? So that was kind of some of the motivating facts that we had growth in output per man hour and growth in labor productivity. All right? Okay. How is that linked up? Why would we be getting more output per? What are the hypotheses we could put forward for why either of these or both of these measures might be growing? Why is it a stupid one? Okay. Capital deepening. So you see workers doing better, K over L going up, right? That would be the idea. That K over L rising would be one mechanism. Okay. Anything else? Anything else? That's it? That's all we can do? That's all, yeah. Okay. Yeah, technological change. That is, we're getting new technologies. I mean, the way to think about that is There are things we know how to do today that we didn't know how to do 50 years ago, 20 years ago, 10 years ago. I mean, there's a lot of new technologies been emerged. Go back over 100 years, I mean, there's a ton of technologies that we really didn't have access to. Right? So I think technical change, clearly part of the story, something that people wanted to talk about. Anything else? Oh, that's another one. Good. Human capital, a different form of capital deepening. Right? It's like capital deepening, except for it's about the people rather than the physical assets, right? Is that on average, workers have more skills. They know more. They got more talents. They've learned more investment in the people. This is, frankly, more investment in capital. This is more investment in people. And surely, if you look at how much we're investing in people on a per capita basis, we've had an enormous increase in that. Over the 20th century, we were increasing the level of education at almost 1 year per decade. So that's a lot. We were really increasing the level of human capital that people had. We went from a world in which many people had less than, just a few years of schooling to where most people had graduated from high school. I mean, that's a big increase over that period of time. Anything else? Any place else we could be getting more output? Yeah. Yeah, I mean, one way to think about it is sort of better allocations. And I think that's one economists haven't really done a great job of modeling, but I think it is actually quite important. That is we've become more efficient. We've kind of used our resources better. Yeah. Yeah, I mean, I guess the question is I think when people think about this, they tend to think about technical change as kind of more like you could measure it within an organization, say. Whereas I think a lot of people, at least the things people would emphasize here, is it's kind of more market level, kind of more aggregate allocations, moving people from places where they're less productive to where they're more productive, or moving capital from where it's less useful to more useful, kind of a market level. I agree, you could think of technical change as, like, you could argue there's no technical change. That is, the laws of physics are actually the same as they were 500 years ago. That if you wanted to make a semiconductor 500 years ago, you could do it, right? Right? There was no impediment from a purely true technological point of view to making a semiconductor in 5000 BC. Right? No, there wasn't. I mean, they would have had to build a lot of intermediate things to make it. But what I'm saying is the laws of physics haven't changed. So there really isn't technical change at that. So everything is allocation if you really get down to the end of it, right? Right? It's the molecules that they put into that fab that makes those semiconductors. And if they had put them same molecules in a fab in 5000 BC, they would have got semiconductors coming out the other end. Right? So it is about where you allocate resources. But, because we haven't created any new resources, right? They're all still there. Pythagorean theorem still worked before it was ever invented, right? All those things. So I guess I'm saying, what do people think about here? They think about this really as kind of market level, kind of moving resources. This is more macro level, this is more micro level. This one more micro level. But I think these are pretty much where people tend to focus when they think about why we're getting more output over time. Yeah, it's interesting how I guess what you could say is there's kind of feedbacks that happen here, like the improvement in transportation has been one of the things that has improved allocations. So you might ask, well, geez, should I attribute that to the transportation, or is there an independent effect of that on allocation? And I agree. But that's closely related to the following point. In general, you can't hardly think about any of these things in practice without some of the other ones. That is, you invent a new technology, well, you probably need some capital, because the old capital probably isn't going to work on that new technology, at least as is. And you're going to probably need some human capital because there can be some know-how associated with it. So these things, it's like production in general, right? When I write down y equals f of L and K, how much of that output was produced by labor and how much was produced by capital? Well, it's almost like a nonsensical question, right? You really can't say how much was produced by each. You could say how much would each get rewarded in a competitive market where they get paid their marginal products, but there's no sense to which you can say some of it was produced by capital, some of it was produced by labor. You could say what could capital do without labor? You could ask what could labor do without capital? Unfortunately, those two generally won't add up to the total, right? If there's some complementarity, which there usually would be, you would probably say, well, what do I do with the rest? I don't know how to allocate the rest between labor and capital. It's a joint product. Same is true of all this progress. There's a joint project. And all the decompositions we're going to do, when people decompose the growth, all depends on the path you took to get there. It's along the path who made the increments, right? Everybody understands that, right? Everybody understands? No? Let's assume the following. In order to get more output, I had to build a road and I had to build a vehicle. And if the road is always running ahead of the vehicle, then it'll look like the vehicle is the key factor, right? Because you see all this road and it doesn't do anything until the vehicle arrives. On the other hand, if the vehicle's out there and is waiting for the road, then you say, well, geez, the road is the key factor, right? So it always depends on who's running ahead of whom. But any time you're doing any kind of allocation, you can always allocate on the margin at that point in time based on who's scarce at the moment, but it doesn't really answer this question. It's just like you could say, I'm going to go from 0 labor and capital to this combination of labor and capital. And if I do it by allocating marginal production along this path, I'll get a different answer than if I go along that path, right? Because along this path, I'm going along a path where there's relatively abundant labor, so I'm going to always make the marginal product of capital higher than it would otherwise be. So I'm going to end up attributing a lot of it to capital if I go this way, and I'm going to end up attributing a lot to the labor if I go that way, right? Because that's like my sidewalk in the truck again, because in this case, labor is kind of acting like the sidewalk running out, the road running out in front of the truck. So it looks like the truck is the limiting factor, right? That's what I'm saying. Any of these decompositions, once you accumulate them, they all work well locally, but globally, the point is you never solve the complements problem. You never really solve what made the cake. Was it the flour? Was it the eggs? Was it, whatever. A cake is made by the combination of all those things, not by any one. You can ask on the margin, how much worse would the cake be if it had less egg or how less flour, but you can't say of the cake as a whole how much came from each. That's not, I don't even know if it's a well-defined question. Let's think about technological progress. Well, how do we measure? We've measured productivity. How do we measure technical progress? Anybody know? TFP. What is that? Total factor productivity, right? So you can think of growth in labor productivity. Growth of Y over L is delta Y minus delta L, right? Where I use this delta symbol to mean percentage change, or D log, or change in logs. So the change in the ratio of Y over L is just the growth in output minus the growth in labor. So if output went up 6% and labor went up 4%, we'd say labor productivity went up 2%, right? That's how we measure it. We got 6% more output with only 4% more labor. We must have got the 2% from somewhere else, right? That's the growth in labor productivity. Now, total factor productivity works the same way. Delta TFP is going to be measured as delta Y, but instead of subtracting off just the growth in labor, I'm going to go subtract the growth in total input. And the growth in total input is going to be measured as share of labor, delta L, plus the share of capital, delta K. Now, how can we motivate that? Well, if we go back to our motivation we had, remember we had that CRS model. In fact, this equation doesn't even depend on CRS. But when we had that CRS model, we said, look, this is the predicted increase in output based on the change in labor and the change in capital, right? All we need to use is labor and capital being paid their marginal products will give you this relationship. Well, this is the share of value of output paid to labor. This is the share of value of output paid to capital. Now, if you didn't have constant returns to scale, those two numbers wouldn't add up to 1. That's the only difference. With constant returns to scale, they'll add up to 1, but this formula would work even without constant returns to scale. All right, so that's going to measure. But it's kind of the same idea, right? Because it's output growth minus input growth. Did output grow faster than input? If output grew faster than input, then we must have some technological progress. People often call this a residual measure of progress because it calculates the difference between actual and predicted, just like a regression residual would be the difference. Yeah? Sure. Technical regress. Right? Yeah, you could have technical regress, no question. Okay? Certainly with the measured inputs. Okay? Like, for example, you might have technical regress on a particular location. If it's becoming like, oil field might be becoming depleted, so you're going to have some technical regress. Now, that's not really technical regress. It's really there's a factor that's shrinking that you're not counting, which is the size of the oil reserve. But in general, this is going to measure some unmeasured factors. It almost always, are those unmeasured factors getting better or worse? All right? Now, we can also measure total factor productivity on the price side. Just like we had two measures for labor productivity, we had real output per hour and we had the real wage, we can measure it here as SL delta W plus SK delta R minus delta P. Again, this is a residual, right? And this one does require constant returns to scale. This is the predicted increase in the cost of output based on the cost of inputs. And this is how much output prices actually went up. So if output prices are going up slower than input prices, then we got to be getting more productive. How are we getting more money to pay the inputs if the outputs are not going up in price as fast as the inputs? We must be getting more productive. In fact, with constant returns to scale, it's easy to show that these two numbers are equal to each other. That is, they're equal. These two have to be the same just because of the accounting. The left, if you move delta Y and delta P over to one side and all the other ones over the other side, it's just growth in the value of outputs minus the growth in the value of inputs. And if you have constant returns to scale, outputs and inputs have to be growing at the same rate in terms of value. Okay? Baxter exhaustion would tell you that. All right? Yep. Yep. Oh, it's a residual. It's a residual. It in reality is going to get 2, 3, and 4. All 2, 3, and that's an important point. This measure is going to get 2, 3, and 4 in there. Right? No question. They're all in there. In fact, if there were other inputs that I wasn't measured, they're in there too. Right? Anything that's not, it is a residual. Anything I'm not counting is in there. Okay? Right? So I agree. 2, 3, and 4 are in there. I just want to think about a world that only has 1 and 2. So I want to assume, for the moment, 3 and 4 aren't happening. The world is being driven only by 1 and 2. Now you can rewrite this equation a couple ways. Is delta Y minus delta L, right, on this side. Well, if I want a minus delta here, I got to actually add, I got to subtract from this side an SK delta L. Everybody agrees? Okay. Or, I'm sorry, I got to add it to that side. So equals SK delta K minus delta L plus delta TFP. Okay, you can just verify my algebra if you want. But this is exactly the formula we were talking about. That is, this is growth in labor productivity. Growth in labor productivity has to be equal to technological progress. That's my number 2. And this is what we call capital deepening. That's number 1 that I put on the board, right? These numbers are not how important they are. They're just the numbers I put up earlier, right? There's no significance to the order, all right? So that would be a way to think about growth in labor productivity. Okay, so that earlier looking at labor productivity up on the first board is really saying labor productivity would be in this world coming from 2 places, effect of technological progress and capital deepening. Now, the neoclassical growth model, of course, says that these 2 things aren't unrelated, right? Because what did the neoclassical growth model we did the other day say? What would happen if you had technical progress? What would it induce? It would typically induce capital deepening. Because if it raised the marginal product capital, we'd then want to have more capital, and we'd keep increasing capital until the marginal product capital came back down to its long-run level. So these 2 things would be causally related to each other, and they would complement one another. That is, improvement in technology would typically be associated with a further growth in output per worker generated by capital deepening. Okay? Any questions that people have? Okay? So that's one equation I want to keep in mind. Delta Y over L equals SK delta K minus delta L plus delta TFP. My second equation I want to rearrange slightly differently. Delta TFP equals SL delta W over P plus SK delta R over P. That is, all I'm going to do is take this delta P and distribute it between these 2 pieces. So I'm going to bring the delta P, I'm going to put an SL of it with this one and SK of it with that one. Remember that those add up to 1, that's cool. And I can have change in the real wage. Now this is a really important equation. It says, look, if I have constant returns to scale, then if I didn't have productivity growth, and this gets back to your point from before, if I didn't have productivity growth, my ability to increase W over P, increase the real wage, could only come from something else, which would be reducing the real return on capital, right? They're on a teeter-totter in that case. You want to push one up, you've got to push the other one down, right? So the only thing that's going to allow both of them to grow, or one of them to grow without the other one growing, is technical progress, which is why I think technological progress is thought of as being pretty important when we think about long-run growth of the economy. Because it's hard to think about, well, we're going to drive this up perpetually over time by continuing to drive this down, right? Yeah, maybe. You might come up with a model that says, I can perpetually drive down the return to capital, but at least the neoclassical growth model doesn't tend to say that. It says, look, you know, maybe I could hold that constant. Or maybe I could make it fall a little bit if people become a little more patient. But you're probably not going to be able to drive it down. You know, think about 100 years of growth. Maybe this number goes up many, many times. Hard to believe you're going to be able to cut this enough to make that happen, right? You're going to have to really cut the hell out of the return to capital. In fact, you'd be very limited, right? Because if you just can't how much can labor share? You know, this is just not going to happen. If you want to quadruple this term, I don't know. I mean, there's not enough there. Not enough there. So what does the neoclassical growth model say? What does the neoclassical growth model say if we had a very large increase in technology? What does the neoclassical growth model say? Well, the neoclassical growth model says, let's assume we had an improvement in technology. Technology goes up. Let's assume initially it raises both of these. Let's say this is 20%. 20% improvement in in technology. This is plus 20, and this is plus 20. How does the neoclassical growth model think about that? What's going to now happen? Now we're going to have capital deepening, right? And as capital goes up relative to labor, what's going to happen? Well, think of it this way. Delta W minus delta R time equals 1 over sigma delta K minus delta L, right? Right? That's just substitution, right? Substitution between labor and capital. This is the elasticity of substitution. So as K over L goes up, W over R has got to go in the opposite direction. And since what that means is this is going to come down, and that's going to come back up. And at the end of the day, in the neoclassical growth model, delta R over P is going to be 0, right, in the long run. Delta R over P equals 0. And if that's true, then delta W over P equals delta TFP divided by the share of labor. Okay? That is, at the end of the day, the real wage is going to grow after capital is caught up and driven its return back to its long-run level. The real wage is going to go up by that amount there. It's going to go up by more than the growth in productivity because labor is going to get all the benefit. All the benefit of the growth in productivity in terms of price growth is going to show up with labor. There's going to be more capital. Doesn't tell us that labor share is going to grow, but because basically what's going on, W over R is going up, but K over L is going up too. So labor share, who knows, right? Labor share relative to capital share. SL over SK is WL over RK equals W over R divided by L over K over L. I don't know which way that's going because this is going up, but this is also going up. And in fact, what's going to happen to that ratio in this model, if I had this initial neutral progress, would be determined by sigma, right? If sigma was 1, then what would happen? Labor share would stay constant. Sigma was bigger than 1, then W over R is going to grow less than K over L, and labor share is going to fall. If sigma was less than 1, then W over R is going to grow more than K over L, and labor share is going to rise. All right? All right. So what do we think is going to happen here? So the neoclassical growth model has a view of long-run growth, has the following sort of view, at least the way we've done it. Long run, delta W over P equals delta TFP over the share of labor. Delta R over P equals 0. All right. Now, why is it in the model I wrote down? You wouldn't have guessed. How many people would have guessed when I wrote this model down that capital would be very elastically supplied in this world. I don't think there's many people would ever guess that. Doesn't seem intuitive. Why is it in this growth model? Is it a weird quirk of the model I wrote down that made capital very elastically supplied? Think about if I had written a much more general utility function. U of C1, C2, all the way, infinite number of consumptions. I've written down some non-separable general utility functions. What is it that we're using? What we're saying is, if you increase current and future consumption together, that is, increase not just current consumption, but also future consumption, that the trade-off people are willing to make between current and future consumption doesn't really change. That's what causes capital to be very elastically supplied in this model. In my model, the rate of time preference is independent of the level of consumption. As you expand consumption out proportionately, the trade-off between current and future consumption doesn't change. So now once you look at it that way, you realize the neoclassical growth model assumption isn't even an extreme. Like, what would happen is if you got richer, you got more patient. That is, as you got richer, your patience went up. Then rho wouldn't be a constant anymore. But when you became more productive and you got richer, what would happen to rho? You got more patient as you got richer. Rho would actually go down, which means the longest supply of capital would actually be downward sloping, not upward sloping. The whole point is the elasticity of supply of capital here has to do with the willingness of people to postpone consumption. And if as you accumulate capital, you become no less willing or even more willing to postpone consumption, you will not get an upward sloping supply of capital. There's another assumption built into the model that's not so obvious, which is this one, that says there's nothing going on the production side that favors consumption over investment as we kind of increase the capital stock. That is, the effect of accumulating capital on the relative cost of investment and consumption is neutral, right? But just like the time preference assumption, that could go either way. It could be that as we accumulate capital goods get relatively cheaper relative to consumption goods, which would further reinforce this effect, right? That is, a relative price effect could go the other way. Remember when we talked about like the housing model or whatever we wrote down? One key assumption of the model was that the output wasn't used as an input, right? That when the price of output went, that it didn't feed back into the input. And here, that's not true. That is the same output used as an input. So we have two neutrality assumptions built into the neoclassical growth model. An assumption that the trade-off between C and I is unaffected as we accumulate capital, which could go either way. As capital went up, it could favor more investment or favor consumption goods, basically depending on whether the production of investment goods or consumption is capital intensive relative to one another. On the other side of the equation, we've had an assumption on preferences that says as we increase consumption levels, our willingness to postpone consumption doesn't decline. Often what's funny is people that sort of argue the neoclassical growth model doesn't fit the world are some of the same people that argue that your time preference goes down as you get richer, right? Because if your time preference goes down as you get richer, you're actually going to get downward sloping supply, not upward sloping supply. People get the idea. People see what's going on. All right. So the basic question then, okay, and I'm going to make sure this is clear. This is capital per worker. capital divided by labor. Capital per unit labor. Doesn't even have to be per work. It's just per unit labor. You could have labor supply in the model. Capital divided by labor. It's capital per unit labor. You can think of the marginal product schedule, FK. That's the marginal product schedule of capital. And this says, if I draw a horizontal line at rho plus delta, this is K bar. That's my steady state capital stock. All right. Now, remember, output is just f of k. But the integral from 0 to k of fk of s ds, that is, the integral under this marginal product schedule, is equal to what? How many people remember math? What's the integral from 0 to k of the derivative of a function? That's f of k minus f of 0, right? Everybody agrees with that, right? The integral from 0 to k of the derivative of the function is the function itself at k minus the function at 0. This is how much output a unit of labor produces when it has no capital. This is the output of a unit of labor that has no capital to work with. This is the output of a unit of labor that has k units of capital to work with. Since there's constant returns to scale, remember this is the amount that's being paid to capital, right? Because this is the price of capital, rental price of capital, times the amount of capital. That's the amount that's being paid to capital. So this area here is equal to the wage minus f of 0. Right? That's what that area is. That is, workers are getting f of 0 plus this surplus on the production generated by capital. Right? That would be the real wage paid to labor. So the real wage is going to be this area plus f of 0. Since I'm thinking of this as a constant, I'm just going to ignore this in most of my discussion. If you want to put it back in, you can put it back in a bit. All right? So everybody sees what I just did. Since we have constant returns to scale, payments to labor and capital exhaust the total. And therefore, the area under this curve is total output minus F0. So this area here has to be the payment to workers minus F0. And everything's done per capita, so that's the real wage rate. Okay, that's the payment to labor in terms of units of output. Any questions that people have? All right. Now I want to apply this model to a very particular situation, which is how would we use this model to analyze the effect of a capital income tax? Okay. So, draw my picture. Here's my capital stock. FK. Here's my elastic supply of capital. This is rho plus delta. That's my competitive equilibrium, K star. Right. Now, what would happen in a world where there was a capital income tax? That is where capital was being taxed by the government. What would happen? What would happen? There was a tax on capital. Well, instead of being here, there would be a horizontal line that would reflect not just what you have to pay the owners of capital, which is rho plus delta, but what you have to pay, including the tax being paid by the government. This would now be the equilibrium capital stock, K bar. This would be the tax revenue of the government. So would be the government revenue. And this would be received by the capital owners. And this would be what's received by the workers, but the workers would also get F0, right? Then we get F0 plus this triangle. That's what workers would get. They would get F0 plus the triangle, right? W equals F0 plus the triangle. Everybody agrees with that? That would go to the government. That's the equilibrium wage to workers. Now, what would happen if the government eliminated the tax on capital? Well, first off, who's paying the tax? Who's paying the tax in this world? Well, the real wage would have been this area plus F0 if there hadn't been a tax on capital. Instead, the real wage is this area plus F0. So the workers have lost out from this capital tax to the tune of that trapezoid, right? That's how much workers have lost from the capital tax. So in this world, workers are not paying a cent to the government as measured by checks written, right? In this world, workers live in a paradise. They never pay a dime to the government. All the money paid to the government comes from the greedy owners of capital, who pay the entire amount that's collected by the government. But nonetheless, the true burden of the tax would be entirely on workers. Okay. Everybody understand that? That is relative to a world where there was no tax, the true burden of the tax. Now you have to ask, what does the government do with the money? Because there is some revenue that comes out of this. I don't know, maybe they give it all to the capital owners. Maybe they give it all to the workers. They give it to somebody. But it's true, this is the amount going to the government. So the workers pay the tax. Actually, the workers not only pay the tax, they pay the deadweight loss from having less capital than you'd have in the non-taxed equilibrium. In fact, in this world, you'd be better off taxing workers directly because you could raise the revenue with a somewhat lower effective tax rate, right? You could actually lower the overall taxes collected because you would end up collecting, you would eliminate the distortion in the usage of capital. Okay. Any questions that people have? And that's true even if labor is elastically supplied, because if you get rid of the capital tax and replace it with a direct labor tax, the real wage rate is actually going to go up, not down. So you're going to have less distortion in the labor market as well. All right. So this would be kind of the classic picture. And when you've heard people discuss, well, geez, what would happen if we had a capital income tax? People said it's crazy to think that workers could gain more than the reduction in tax. This model actually says in the long run that would have to be true. That is, the gain to workers would exceed the tax reduction. Now, in fact, it has to be bigger for another reason, which is, if you think about it, when you have a 50% tax on capital income, what does that mean? Well, since you have to have the same after-tax return on capital, the pre-tax return on capital has to be double what it would have been, right? Everybody understands that, right? In order for capital to get $1, the pre-tax return has to be $2, so that once you take a 50% cut, they're left with the full $1, which is what you need to have if you have elastic supply. What would happen if you cut the tax rate from 50% to 49%? What would happen? Remember, the rental price of capital, think of that normalized as 1. The owners of capital have to get 1. Well, how much would government revenue go down if you cut the tax rate from 50 to 49? Remember, the price of capital is 2, right? The rental price of capital currently is 2. The government's getting 50% of that. So the government's getting $1, and $1's going to the owners of capital. What would happen if you cut the tax rate to 49%? Well, if the rental price of capital stayed at 2, the government would now collect 49% of 2 instead of 50% of 2. So the government would lose 2% revenue. But is the price of capital rental rate going to stay at 2? No, because you need to get a post-tax return. So it's going to fall to something closer to 198. So the government's actually only going to get 49% of roughly $1.98. So actually their revenue is going to go down by 4% per unit capital rather than 2%. All right. So that's another thing to keep in mind, that the equilibrium price of capital is going to get smaller. All right. Now, so in this debate over what would be the effect of a corporate tax cut on the returns to labor and capital, the view that if capital is elastically supplied, that the benefits are going to workers are going to exceed the tax cut is pretty well grounded in the underlying theory. Now remember, that's a long run answer. It's not a short run answer. In the short run, what would happen? Well, in the short run, if capital was fixed, all the benefits would go to capital, just like they did just like capital got its share of the productivity improvement. They would only gradually be competed over to labor in this simple model. Yes?
For example, the government revenue wouldn't go down by 4%. A would rise, right? Or you're assuming K is fixed in the short term.
In the short term, K is fixed, right? So when K is fixed in the short term, the government taxes capital less, the marginal product capital stays exactly where it was. And since the marginal product capital is where it is, the pre-tax price of capital stays at 2. Government now gets 49% of 2, so that means capital owners get 51% of 2. Gradually now, though, because capital owners are now getting 102 rather than 100, they're going to increase the capital stock. And as they increase the capital stock, the rental price of capital is going to come down. So the government is now not going to get 49% of 2. They're going to get 49% of a number less than 2. Right? That's what's going to happen as the price of capital. Yes?
You said even if the supply of labor is elastic as well, it would be better to...
Right, because all this is per unit labor in equilibrium. So reducing labor doesn't kind of offset what's happening here, because as you cut back labor, that just cuts back capital even further. It doesn't prevent capital from going down, right? Because if labor is reduced, because you have to get K over L to its long-run equilibrium level, capital is falling right along with it. Right? If one of them's this is basically the thing. It's like when supply, let me give you the other analogy that I think makes it clear. It's like when you have supply and demand in a market, right? If you make supply perfectly elastic, it doesn't matter how elastic demand is. Demanders pay the entire tax no matter how elastic demand is. It affects how much quantity goes down, but it doesn't affect a fraction of the tax that they pay. And that's kind of the point that happens here. Once you make one of the factors perfectly elastic, then the other one has to pay everything. And not only pay the tax, they have to pay the distortion too, because the factor that's perfectly elastic won't pay for anything. It's just like in this model, the split between labor and the split between buyers and sellers in the standard tax problem depends on both elasticities, unless one of them's infinite. Because if one of them's infinite, it doesn't matter how elastic you are, you're still paying 100% of the tax. It's the same thing that's going on here. Once I make capital perfectly elastic, no matter what, labor can't run fast enough to get away. That's what's happening here, right? The buyers, they can try to run, but capital is always going to outrun, suppliers are always going to outrun them in this world. That's kind of what happens over here too. So now if you make one of them less than perfectly elastic, then the elasticity of the other one will still matter. Okay. For the same, it's basically the same logic that's happening here. All right. Yes. Any questions that people? That's kind of like Malthus's thing. Malthus's view. Even if he got more land, it doesn't matter. Workers are going to just keep growing and growing and growing until they're just as poor as they ever were. Yes.
What kind of things would prevent the initial surplus to the capital owner going to real estate? So that area.
You'd have to have something that, remember, one way to think about it is C of W and R and 1 has to be equal to 1 if you express them in real terms, right? In a model like this, that is the cost of producing a unit of output has to be this. And therefore, if you kind of raise this, then you got to lower that. I mean, you can't do one without the other in this kind of fixed technology world. And I mean, you need some kind of reason why capital is upward sloping or something like that. Now, one of the things that, for example, in his piece, Larry Summers talked about was, what if there is a tax sector and an untaxed sector? What if there's one sector that taxes capital and another sector that doesn't? So I'm going to modify my production function a little bit, and I'm going to make it f of k, or we can make it k and l, it doesn't matter. Where k, this is now going to be a capital aggregate. And k equals some function g of k1 and k2. That is, my capital is now a function of two underlying types of capital, k1 and k2. And I'm going to stick with my assumption that y equals c plus I1 plus I2. That is, by the way you produce either type of capital is just give up consumption to get more of it. All right, so same picture. Okay. All right, so you can put your investment into either type of good, but they're imperfect substitutes in production. All right, so that's going to be my model. Okay. Now, I'm going to think about an equilibrium now where you tax K1, you don't tax K2. Okay, but you get the idea. We're going to tax one. So in Larry Summers' example that he talked about in his article, he's going to think about the corporate sector that pays a corporate tax and some other sector, the non-corporate sector, that doesn't pay a corporate tax. All right. So what does my picture look like now? Well, I'm going to assume that this function is CRS. If it's CRS, then it makes my life very easy, because whenever you have a CRS production function, you could just think about the unit isoquant, right? Tells the whole story. I'm going to have G, this is K1, this is K2, this is G of K1, K2 equals 1. So that's the amounts of K1 and K2 that can be combined together to produce one unit of this capital aggregate. Absent the tax, you would go to the point where the slope of this line is 1, right? Because they're perfect substitutes in production. You can buy one unit of one or one unit of the other, so they got to be equally valued. And in fact, that would determine the cost of production. Your cost of production would be determined by the amount of either K2 or K1, right? Either of these would be equal to the cost of a unit, right? Because that's how much K it takes to produce 1 unit of the capital aggregate, right? This is how much input it takes to produce 1 unit of capital aggregate. Okay? So this point here would be equal to C of K. It would be equal to, I'm sorry, unit cost of K. Now, what happens if I tax one of these goods and not the other? What does that do to the mix that people will use in production? Well, it's going to mean one of them is going to get more expensive and one of them is going to get relatively cheaper. I'm going to shift my production, say, which one did I tax? I taxed good one, so good one got more expensive. I'm going to shift my production this way. Right? Right? That's going to be how much I shift my production toward good using K2, because K2 is not taxed unless of K1. So for any amount of the capital aggregate, I'm going to produce it using a different mix. Now, how much does that cost? How much does it cost to produce output? Any idea? Well, since K2 is not taxed, that's the cost of producing a unit of output, right? That's how much it would cost to produce a unit of output, right? That's the amount of I'd spend to produce a unit of output. So the cost of a unit of output went up. All right. So now let's thinking about putting a corporate tax on that taxes only one of the goods. So go back. Run my previous problem in reverse. I put the corporate tax on. Here's K bar. With the tax, I go K tax. Go to here. The loss to workers is this area here. What happens if you do that same effective tax on K, but do it by taxing only one of the underlying capital inputs? What's the difference? Anybody got an idea? Well, if you're still going to have the same effective tax rate, you still got to move up this much, but you're also going to shift this curve up, right? Because we're going to produce capital less efficiently than we used to. Capital is going to be elastically supplied now, but elastically supplied at a higher cost. That is, the real cost of capital is going to be higher than it used to be, which means not only are workers going to lose this rectangle like they normally would and lose this triangle like they normally would, there's going to be an additional loss. So having an untaxed sector is not going to be the savior for workers, given an amount of the overall tax being raised. It actually means that the loss to workers is going to be even bigger relative to the amount collected by the government, right? Because it's going to mean that there's an additional distortion. That is, this supply curve is going to shift up. It's going to cost more to produce capital than it used to. A given amount of the capital aggregate is now going to cost more than it did in the past. So like, let's say they're each 50% of the capital stock. Having a 20% tax on half the capital stock is probably going to be worse than having a 10% tax on all the capital stock, because of this additional cost effect. It's going to make capital more expensive to produce. So not only is that all that 10% effective tax rate passed on to workers, and workers lose the triangle from having less capital, they also would lose the inefficiency now generated by having capital produced in a non-cost minimizing way. We'd have too much K2 and too little K1. Which would shift that supply of capital curve upward in terms of the aggregate capital stock. Yes?
So, just trying to relate
Yeah.
figure with the one you have over there. So is there a rho plus delta that's beneath the
Well, it's not really rho plus delta anymore, right? Because you're no longer transforming investment into output as efficiently as you were before. It's like you became less productive, right? It's like the return on capital is measured by like the rate of return would be the same. That is the delta, rho plus delta would still work, but the price of capital goods relative to consumption goods would be higher now, because you'd be producing capital goods in this inefficient way, right? That is, you could still produce 1 unit of K1 by giving up 1 unit of consumption, and you could still produce 1 unit of K2 by giving up 1 unit of consumption, but the way in which those are being combined to produce the capital aggregate is going to be inefficient now. It's as if you have a worse technology. It's more like a reduction in A in our previous world. It's like we've just made capital less productive than it used to be. Any amount of foregone consumption doesn't generate as much additional productive capacity as it used to, because we're misallocating how we use that foregone consumption. That's the way to think about it. It's more like a change in A. It's more like that production technology has been distorted.